Today's market action wasn't just a quiet end to the week. It reflected a subtle shift in how investors are balancing geopolitical relief against stubborn inflation pressures. U.S. equities closed mixed. The Nasdaq edged slightly higher, the S&P 500 drifted marginally lower, and the Dow underperformed more noticeably. It wasn't a broad directional move. It was a market rotating internally. At the same time, bond yields moved higher, with the 10-year pushing back toward the mid 4% range. That alone reintroduced pressure on equity valuations. Oil pulled back sharply as geopolitical fears eased, while gold saw some profit-taking after recent highs. Volatility declined further, suggesting that, at least for now, near-term hedging demand is fading. But beneath those surface moves, something more important was happening. What really drove today's market wasn't a single headline, it was a shift in expectations. On the geopolitical side, confirmation that tanker traffic is flowing through the Strait of Hormuz under stabilized conditions removed a major tail risk. Markets had been pricing in a worst-case disruption scenario. That scenario is no longer the base case. So oil fell, and some of the defensive positioning built around that risk began to unwind. At the same time, inflation data told a different story. U.S. consumer prices rose to their highest level in nearly 2 years, driven largely by energy-related pressures. Even with geopolitical tensions easing, inflation isn't fading as quickly as many had hoped. And that's where the tension comes in, because Federal Reserve officials reinforced that point today, emphasizing that services inflation remains sticky and that it's still too early to talk about rate cuts. So expectations shifted again, from a brief window of policy relief maybe coming back to a more familiar reality, higher rates for longer, and markets adjusted accordingly. You can see that adjustment clearly in how capital moved. Investors didn't exit risk entirely, but they became more selective. Technology and materials held up relatively well, supported by strong balance sheets and long-duration growth narratives. These are areas where companies can absorb higher financing costs. Meanwhile, financials, healthcare, and consumer staples lagged. That's notable because these are typically seen as more stable sectors. Their weakness suggests investors are becoming more cautious about underlying economic resilience and credit conditions. In other words, this wasn't a risk-on rally, it was a repositioning. Capital is moving toward areas that can survive both higher rates and uneven growth, not necessarily toward broad economic optimism. And that brings us to a more subtle risk developing under the surface. Even though markets are reacting positively to easing geopolitical tensions, that stability may be more fragile than it appears. The ceasefire in the Middle East is holding, but only with some strain. Any disruption to energy flows could quickly reintroduce volatility into oil markets and, by extension, inflation expectations. At the same time, higher yields continue to tighten financial conditions. That puts pressure on credit markets, particularly in more leveraged areas of the economy. So while volatility is falling, underlying fragility may actually be building. An interesting question investors are debating right now is whether this combination, easing geopolitical risk but persistent inflation, creates a stable middle ground or sets up the next source of market stress. I'd be curious how you see it. Is this a temporary balance or the start of a more complex repricing? Because when you step back, the broader message from today's market is fairly clear. This isn't a clean risk-on environment. It's a market trying to reconcile two competing forces. On one side, improving geopolitical stability. On the other, inflation that refuses to ease, and a central bank that can't afford to step in too early. That combination keeps policy constrained and growth uncertain. Looking ahead, the next phase will likely depend on a few key developments. First, whether the ceasefire continues to hold, and more importantly, whether energy supply flows remain stable. Second, upcoming inflation data and central bank communication, which will shape expectations around the rate path. And third, early signals of stress, particularly in credit markets or financial institutions, as higher rates continue to work through the system. The broader takeaway from today's market reaction is that investors are no longer reacting to isolated headlines. They're adjusting to a world where stability and pressure coexist, where risks are lower in one area but building in another. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this type of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today.